there's a lot of interaction with the management, and a lot of independent sources of gathering the information. Those are the classes which are easy to analyze. However, also keep in mind that the assets which are easy to analyze are actually not the places where you should search for alpha. The chances are higher of getting alpha where the asset classes are difficult to analyze. Where it's easy, a lot of other people will also be able to analyze and arbitrage away any advantage one has. Another question is that real estate is considered a very risky asset class, and so can we get alpha there? That's a very good question. It is a risky class, and as we said, the so-called perceived risky classes are which most alternative investments are, including real estate, are where one should expect high returns and high alpha. Now, how do you? Now, it's not that just because it's a risky class, you will be able to generate alpha. You have to think, and in that specific opportunity or that class of opportunity or asset classes, one has to understand what are the issues, what are the risk factors. Once you have understood and enumerated all the risk factors, you understood the frequency and the magnitude of impact, that is when you start looking at whether you can eliminate some of those factors, whether you can mitigate some of those factors, and worst case, can you control and manage those factors? If you find you can do that
better than the
others, that's when you
do investment
and generate.
There is a question from one Mr. Dave Karlekar.
Mr. Karlekar, you're asking,
can we blend value investing? Mr. Karlekar, you're asking, can we blend value investing with technical analysis? There are people who claim to do both. However,
in our understanding,
value investing is
based on
fundamental analysis, and that's how you find an opportunity. When a security is significantly below its intrinsic value, that's when you do a buy. Now the dealer, the trader who is actually going to execute the trade might use technical analysis for carrying out the actual buying order. Okay, but however, we don't really encourage having the actual investment manager taking the value investing and technical analysis at the same time. There's another question, Mr. Dhawan. See, some of those factors I discussed during the presentation, which were factors like the book value, the earnings, the cash flow, the revenues, the dividends, etc. But if you get to the heart of it, you're trying to basically estimate a valuation of the security which you are holding, and that valuation will be driven by what is the underlying assets. So you go through it asset by asset on the balance sheet, and you adjust the book value, because the historical book value would be what is that you see on as net worth on the balance sheet, but you have to adjust it for the current market value or the projected value realistically and conservatively. Once you do that, if you see that the actual security is available at a significant discount to that adjusted book value, then you can consider a buy. Okay. However, book value is a starting point. Some businesses actually earn much higher returns on the book value as compared to other businesses. In which case what happens is you have to start looking at the earnings and the return on equity. So now you're going not only on the book value, but by the returns that business is generating on the book value. Okay, and then that return has two factors. One is the extra return compared to the above the cost of capital which you are making, and the third is the growth factor. Okay, and so those are the factors which you should look at from the balance sheet. Now, another question being asked by Mr. Marwana is how do we decide the horizon for investment? Okay. See, the horizon for investment is not known beforehand. Okay, you're looking at the security, and let's say you find a hidden asset in the balance sheet. Maybe there is some land asset which is not being priced in, okay, and which is not being utilized to generate the earnings. So the stock is being valued on the earnings, and there is this extra asset lying around. Now, if you are going to value and pay for that, then you have to have an idea of over what time horizon that is going to work out. Okay, and that's when we have to do various conservative estimates. You should see whether management is planning on doing something with those assets, those unused or non-performing assets. If management is giving a clear view and there is a time horizon, you factor in a little bit of more buffer factor of 20-30% more, and you try to hold that horizon. If there are things, you also look for catalysts. So let's say in some situation the earnings are low and there is no visibility on when the earnings are going to be high. But if you analyze what the management is doing, it's investing in new plants, new products, new R&D, then there is a judgment on over what time period that new product launch will work out and when the new plants will work. And if you factor that kind of a time frame with maybe a buffer of several quarters built in, then again you have a rough idea of what is the time horizon. So it's not a science, but it's a discipline, it's a judgment, it's a expertise you develop over a period of time by investing more and more.
Yeah, we have one question coming from Mr. Dev Kalekar again.
Okay. Mr. Karlekar, you are saying
Valuation of an equity are market cap. Mr. Karlekar, you are saying that some of the factors in your understanding which go into valuing an equity are market cap, book value, EPS, price to book, price to earnings, dividend yield. Okay. Yes. See, it's while these are factors which you have stated, market cap is a result. Okay. Market cap is not the factor which goes into valuing a security. Market cap is the result of the investors valuing a security and then pricing it. Okay. So book value, true. Book value, yes. Okay. In the sense that you are saying fine, large caps. Okay. In that sense, you can look at market cap. Very tiny companies you might not want to look at. So to that extent, yes, market cap is just a screening variable. Book value is relevant, but again, historical book value is of a limited value. Again used as a screening factor. But the adjusted book value, you have to adjust the balance sheet to the current market value which you expect. Okay. Yes, earnings per share, true. However, even better is cash flow because earnings are managed most of the time. Price to book is a factor, yes. Again as a screening factor. Price to earning again as a screening factor. And dividend yield is important but not so important. What you want to really see is what is the business, the return on the business. So either the return on capital of what that business is. That is the primary factor if you want to look at a high quality company. Okay. If you look at return on capital and that is high, then that company enjoys some competitive advantage. And if relative to that advantage it is priced low, which you will find out doing some kind of a DCF. I don't think yeah, I get your question, which is, any scripts where we can look at this. Yeah, again, we all know the scripts, which major scripts which are available, but we can discuss this offline, I think, because this is a public forum. Any discussion on any particular scripts will be taken as a kind of, informal recommendation, etc. So we would not like to discuss that, but offline we can do that on email, etc.
Great. So I see we don't have any more further questions, and I guess we can wind this presentation up. So I would really like to thank Dr. Gupta for his knowledge, sharing with us his knowledge, and for giving us an insight into alpha value investing and the whole concept with supportive examples and data. I would like to thank one and all for participating and attending this event and being a part of this presentation. Do join us for the next event, which is going to be held shortly. Thank you once again.